Hello students, welcome to the lecture on concept of national income. And after this lecture, we will be able to learn the following objectives. Explain the national income. Discuss the measures of national income. Describe the methods of measuring national income. Explain the expenditure approach. Discuss the problem of computation of per capita income. Let's start with the concept of national income. National income is the final output of all economic activities of a nation valued in terms of money. National income is the most important macroeconomic variable and determinant of the business level and environment of a country. The level of national income determines the level of aggregate demand for goods and services. Its distribution pattern determines the pattern of demand for goods and services, that is, how much of which good is demanded. The trend in national income determines the trends in aggregate demand, that is, the demand for the goods and services and also the business prospects. Therefore, business decision makers need to keep in mind these aspects of the national income, especially those having long-run implications. National income, or a relevant component of it, is an indispensable variable considered in demand forecasting.
National income accounting is the science of how we measure an economy's overall economic performance, focusing especially on the overall level of production of goods and services. Why is this important? Well, the reason we care about jobs, income, etc. is that we use the income to buy goods and services. Total production of final goods and services is approximately equal to national income. We can use these measures to assess the health of the economy by comparing output per person across countries and across time periods. We can use these measures to track the long-run growth of the economy. And we can use these measures to assess the effectiveness of macroeconomic policies. The measure we use most is gross domestic product. This is the total market value of all final goods and services produced in a given year. It's necessary that we use a monetary measure because we're literally adding apples to oranges to tractors to computers, etc. So we use a market value. To avoid double counting, intermediate goods are not counted, only final goods. I'll explain why on the next slide. GDP excludes financial transactions. And finally, GDP excludes secondhand sales, or sales of used goods. So, let's use an example to illustrate why we do not count intermediate goods. Let's talk about the birth of a suit. A sheep rancher produces and sells $120 worth of wool to a wool processor. That firm processes the wool and sells the material to a suit manufacturer for $180. The suit manufacturer makes a suit and sells it to a wholesaler for $200. The wholesaler stores the suit, ships it around the country, and eventually sells it to a retailer for $250. And the retailer sells the suit to you for $350. If we counted all these transactions, we would get $1,100, when actually all we have at the end of the day is a suit worth $350. This is the reason we only count final goods. Well, what's not counted? Financial transactions are not counted, such as public transfer payments, such as Social Security payments and veterans payments, private transfer payments, such as gifts between family members, and stock market transactions. All these financial transactions are not actually used to exchange goods and services, so they're not counted. Secondhand transactions are also not counted, as they contribute nothing to the production of final goods and services. They are simply just moving ownership of final goods between people. Some shortcomings of GDP. 1. It does not account for non-market activities. For example, you could clean your own house, or you could hire a maid to clean your house. If you do it yourself, it's not counted towards GDP. If you hire a maid, it is counted towards GDP, even though these are exactly the same activity occurring. The value of leisure is not added towards GDP. In 1900, the average work week was 53 hours. Today, it's only 35 hours. Production today is lower than it otherwise would be if we worked longer, but we're happier with the leisure than with the extra stuff. But this leisure, the value of that leisure, is not counted towards GDP. Improved product quality is often not counted towards GDP. For example, a $300 computer today is much better, much more powerful than a $3,000 computer in the 1980s. It does not include the underground economy, so this could involve illegal activities such as the production of drugs, or it could account for innocent things such as you hiring the neighbor 12-year-old kid to mow your lawn. In small underdeveloped countries, an underground economy can be much bigger and important than it is for a country like the United States. It does not include external costs. Imagine an oil spill. The costs imposed on society for cleaning up GDP is actually added towards GDP. And finally, it says nothing about income distribution, whether the production of goods or services or the consumption of goods and services is spread out equally, fairly, or unfairly.
Let us now discuss national income. National income is defined as the sum total of all the goods and services produced in a country in a particular period of time. Normally, this period consists of 1 year duration, as a year is neither too short nor a long one. National product is usually used synonymous with national income. Alfred Marshall defines national income as the labor and capital of a country acting on its natural resources, produce annually a certain net aggregate of commodities, material and immaterial, including services of all kinds, and net income due on account of foreign investments must be added in. This is the true net national income or revenue of the country, or the national dividend. The national dividend or income consists solely of services as received by the ultimate consumers, whether from their material or from human environments. Thus, a piano or an overcoat made for me this year is not a part of this year's income but an additional to capital. Only the services rendered to me during this year by these things are income. Basic concept of national income. The important concepts of national income are gross domestic product (GDP), gross national product (GNP), net national product (NNP) at market prices, net national product (NNP) at factor cost or national income. Now moving on to the next topic, we will study the measures of national income. A country's national income can be calculated as gross national product (GNP) of the various measures of national income used in national income analysis. GNP is the most important and widely used measure of national income. It is the most comprehensive measure of the nation's productive activities. The GNP is defined as the value of all final goods and services produced during a specific period, usually 1 year, plus incomes earned abroad by the nationals minus incomes earned locally by foreigners. The GNP so defined is identical to the concept of gross national income, GNI. Thus, GNP is equal to GNI. The difference between the two is only of procedural nature. Gross domestic product (GDP). The gross domestic product (GDP) is defined as the market value of all final goods and services produced in the domestic economy during a period of 1 year, plus income earned locally by the foreigners minus incomes earned abroad by the nationals. The concept of GDP is similar to that of GNP with a significant procedural difference.
GDP is a term that's used a lot in the media, usually in relation to how much business your country is creating or the economy. GDP stands for Gross Domestic Product. It's an estimation of how well your country's economy is doing. It's often measured as a positive or negative percentage point, which not only compares how different countries are doing, but also shows how well your economy is doing. Gross domestic product, put simply, calculates how much business your economy is holding and creating. So how exactly is gross domestic product calculated? Different institutions all around the world that analyse different parts of the economy will add these figures together to come up with the GDP figure. Private consumption. This is all the money that we ordinary people spend on goods and services. Gross investment. All the money that businesses invest in your country. Plus all the government spending that goes into health, education and other government industries and subsidies. Then the office will add up all of the exports, things that countries send out to other countries to make money, then minus the things that it buys in, imports. Gross domestic product is only an estimate, as you can rarely tell with certainty everything that's going on in the country. But it's a good way of showing how your country's economy is doing.
Net National Product, NNP. NNP is defined as GNP less depreciation, that is NNP is equal to GNP. Depreciation. Depreciation is that part of total productive assets which is used to replace the capital worn out in the process of creating GNP. Briefly speaking, in the process of producing goods and services, including capital goods, a part of total stock of capital is used up. Depreciation is the term used to denote the worn out or used up capital. An estimated value of depreciation is deducted from the GNP to arrive at NNP. The NNP as defined here gives the measure of net output available for consumption and investment by the society, including consumers, producers and the government. National income. Some accounting relationships. Accounting identities at market price. GNP is equal to GNI, gross national income. GDP is equal to GNP less net income from abroad. NNP is equal to GNP less depreciation. NDP, net domestic product, is equal to NNP less net income from abroad. Some accounting identities at factor cost. GNP at factor cost is equal to GNP at market price less net indirect taxes. NNP at factor cost is equal to NNP at market price less net indirect taxes. NDP at factor cost is equal to NNP at market price less net income from abroad. NDP at factor cost is equal to NDP at market price less net indirect taxes. Personal income. Personal income is the sum of all incomes actually received by all individuals or households during a given year. In national income, there are some income which is earned but not actually received by households, such as social security contributions, corporate income, taxes and undistributed profits. On the other hand, there are income transfer payment which is received but not currently earned, such as old age pensions, unemployment doles, relief payments and so on. Disposable income. Disposable earnings, also known as disposable income, are a measure of a person's ability to manage essential household costs after mandatory taxes have been deducted from gross earnings. It indicates how much money the employee has left over to spend or invest. Real income. Real income is simply inflation-adjusted income. To exemplify, the nominal income increased today by 10% from last year. The real income remains the same as that from before if the prevailing inflation rate today is 10%. Let's know the methods of measuring national income. For measuring national income, the economy through which people participate in economic activities, earn their livelihood, produce goods and services, and share the national products is viewed from three different angles. The national economy is considered as an aggregate of producing units combining different sectors such as agriculture, mining, manufacturing, trade and commerce, and so on. The whole national economy is viewed as a combination of individuals and households owing different kinds of factors of production which they use themselves or sell factor services to make their livelihood. Net output or value added method. The net output method is also called the value added method. In its standard form, this method consists of three stages: estimating the gross value of domestic output in the various branches of production, determining the cost of material and services used, and also the depreciation of physical assets. Estimating cost of production. The next step in estimating the net national product is to estimate the cost of production including depreciation. Estimating cost of production is, however, a relatively more complicated and difficult task because of non-availability of adequate and requisite data. Much more difficult is the task of estimating depreciation since it involves both conceptual and statistical problems. For this reason, many countries adopt factor income method for estimating their national income. Factor income method. This method is also known as income method and factor share method. Under this method, the national income is calculated by adding up all the incomes accruing to the basic factors of production used in producing the national product. Factors of production are conventionally classified as land, labor, capital, and organization. Labor incomes. Labor incomes included in the national income have three components: wages and salaries paid to the residents of the country, including bonus and commission and social security payments. Supplementary labor incomes, including employees' contribution to social security and employees' welfare funds and direct pension payments to retired employees. Capital incomes, according to Studentsky, capital incomes include the following capital earnings: dividends excluding intercorporate dividends, undistributed before tax profits of corporations. Expenditure approach. The expenditure approach is a method for calculating gross domestic product (GDP) by adding up expenditures on goods and services. The logic behind this approach relies on the idea that people and companies make goods and things for sale, and therefore determining the value of sales provides information about how much they made. This is the only one way for determining GDP. Another method is the income approach, where analysts look at income from labor, investments, and other activities. GDP per capita and income per capita. GDP per capita is nothing but GDP per person, the country's GDP divided by the total population. For example, it would be $60.25 million divided by the total number of people, including the workers who work at each of the Six Brothers factories. Because the GDP is divided by the total number of workers, the GDP per capita very closely reflects the average revenue per person in the economy. Product approach of national income. According to this method, national income is measured in the form of total product obtained from each economic sector, such as primary, secondary, and tertiary sectors. The product approach consists of primary sector. It includes agriculture-based productions like fishery, forestry, and other production activities. Secondary sector. It includes manufacturing, electricity, water supply, and such other public welfare activities. Tertiary sector. It includes banking, insurance, transport and communication, defense, administration, and such other institutions. Thus, GDI is equal to total production of primary plus secondary plus tertiary sector. GNP is equal to GDP plus NFIA. Problem of computation of per capita income, PCI. Per capita income of a country is derived by dividing the national income of the country by the total population of a country. Thus, PCI is equal to total national income or total national population. In common parlance, news reports and economic forecasts, country per capita income is considered as an indicator of a country's economic well-being. Gross domestic product or GDP is an approximate measure of the market value of all goods and services produced in a country during a specific period. How to calculate country per capita income? When country GDP per capita is calculated, it is done by dividing the nominal or real GDP by the country's population. When the GDP is adjusted for inflation, it is called nominal GDP. One method of calculation is to consider GDP at its purchasing power parity, PPP. The alternate method includes making inferences from nominal GDP figures. Country per capita income as economic indicator. Country per capita is used to measure a country's financial well-being, particularly in comparison with other regions or nations. That is one reason why per capita income figures are expressed in terms of international currencies such as US dollars. For a country, it goes beyond being a mathematical formula of economic growth, as it also reveals the quality and standard of living of its people. For economists, however, an increase in country per capita income signifies national economic growth. Economists and policy planners use country per capita income figures to estimate future trends of national economy. Use these figures to devise apt strategies to tackle potential fiscal threats to the economy. Use favorable figures to propel a country's monetary activities. Strengthen a country's economic climate. devise structural adjustments to avert rising inflation in the wake of high purchasing power.
Let us talk about per capita GDP. Suppose there are two countries, A and B. GDP in country A is say $100, while GDP in country B is $200. Which country is better? Simple. B is better. The story is too simple till here. Suppose population in country A is 10, while population in country B is 50. Then how much? What is the proportion of GDP which is being divided among these 10 individuals? Every individual is getting 10 units of GDP in country A. So per capita GDP, that is GDP upon population, in country A is 10, while in country B it is 4. Now which country you think is better? Country A or country B? Of course country A. Well, in case if you compare India with some of the Scandinavian countries, what you found is that India's GDP must be some very high multiple of Scandinavian countries' GDP. But Scandinavian countries' GDP is again very high multiple of Scandinavian countries' per capita GDP is very high multiple of Indian per capita GDP. See, per capita GDP is telling you how much material possessions you can have. Fine. So country with a higher per capita GDP is likely to have more material possessions and hence more happiness. Fine. So you should not stop only at GDP, because GDP is just giving you an aggregate picture. It is not giving you anything else. So you have to move beyond GDP measures. So what we did was, we started with a simple definition of GDP. We said this, but we are ignoring some important facts in that definition. We're ignoring the fact that there would be some people within the domestic economy who are not your domestic, or who are not the residents of that country. So income of those foreign nationals should be excluded from GDP. But there must be some domestic nationals who are working abroad. So their income should be added in GDP. And that makes GNP. Then we went over to talk about real GDP. Prices are always changing. But in case if you're just looking the growth rate based on GDP, you will not be sure whether this change in GDP has occurred because of change in output or change in prices. Then we went one step further and we said that there would have been different population sizes of two different countries. Then how do you compare GDP between these two countries? India's GDP would have been higher than many of the developed countries. But do you think that India has developed that much? For that, we needed per capita GDP.
Advanced estimates of national income. The Central Statistics Office, CSO, Ministry of Statistics and Program Implementation, has released the advanced estimates of national income at constant 2004 to 2005 and current prices for the financial year 2012 to 2013. These advanced estimates are based on anticipated level of agricultural and industrial production, analysis of budget estimates of government expenditure and performance of key sectors like railways, transport other than railways, communication, banking and insurance available so far. The advanced estimates at current prices are derived by estimating the implicit price deflators (IPDs) at sectoral level from the relevant price indices. The salient features of these estimates are detailed here. Estimates at constant 2004 to 2005 prices. Gross domestic product GDP at factor cost at constant 2004 to 2005 prices in the year 2012 to 2013 is likely to attain a level of $27,51,738 billion, as against the first revised estimate of GDP for the year 2011 to 2012 of $26,21,791 billion released on 31st January 2013. The growth in GDP during 2012 to 2013 is estimated at 5.0% as compared to the growth rate of 6.2% in 2011 to 2012. Agriculture. The agriculture, forestry and fishing sector is likely to show a growth of 1.8% in its GDP during 2012 to 2013 as against the previous year's growth rate of 3.6%. According to the information furnished by the Department of Agriculture and Corporation DAC, which has been used in compiling the estimate of GDP from agriculture in 2012 to 2013, production of food grains is expected to decline by 2.8% as compared to growth of 5.2% in the previous agriculture year. The production of cotton and sugar cane is also expected to decline by 4.0% and 6.5% respectively in 2012 and to 2013. Among the horticulture crops, production of fruits and vegetables is expected to increase by 3.5% during the year 2012 to 2013 as against 5.1% in the previous year. Services. The estimated growth in GDP for the trade, hotels, transport and communications sectors during 2012 to 2013 is placed at 5.2% as against growth of 7.0% in the previous year. This is mainly on account of decline of 3.4% and 4.8% respectively in passengers and cargo handled in civil aviation and decline of 3.1% in cargo handled at major seaports during April to November 2012 and 13. Capital budgeting. Capital budgeting is the process of evaluating and selecting long-term investments that are consistent with the goal of the firm. The need and importance of capital budgeting are long-term implication. Long-term implication. Capital expenditure decision affects the company's future cost structure over a long time span. Irreversible decision. Capital investment decisions are not easily reversible without much financial loss to the firm because there may be no market for second-hand plant and equipment and their conversion to other uses may not be financially viable. Long-term commitments of funds. Capital budgeting decision involves the funds for the long term, so it is long-term investment decision. The long-term commitment of funds leads to the financial risk. Hence, careful and effective planning is must to reduce the financial risk as much as possible. Now, in the end, let us summarize what we have learnt in this lecture. National income is defined as the sum total of all the goods and services produced in a country in a particular period of time. Gross domestic product GDP is the total market value of all final goods and services currently produced within the domestic territory of a country in a year. Gross national product is the total market value of all final goods and services produced in a year. NNP is the market value of all final goods and services after providing for depreciation. The expenditure approach is a method for calculating gross domestic product GDP by adding up expenditures on goods and services.